So I'm long ENPH and SolarEdge, SEDG. SolarEdge, I was able to fortunately buy it just before the gap up. So like on, yeah, the day prior, I was long from that area. And Solar and the Enphase I bought on the opening of the earnings gap up. And that was the first earnings gap up I've probably bought in a year. It was
Wow.
finally, I've been watching this sector for the longest time. It said great earnings report, beat, raise, everything was, an A plus on it. So I decided to go long on the earnings report. And what really stood out to me, and sometimes we get so caught up with the market and worried about the market going lower and this and that. I mean, but look at these stocks. Enphase, I mean, the market topped in November. Enphase bottomed in January, and this has been working its way higher all year. So this is really kind of building out. Like if you look at a daily or a weekly chart, you can see either cup and handle, or I see like kind of a giant triangle pattern that was forming. And that's just to me, that was just yelling out that, hey, the market could be as bad as it wants, but this company still has great earnings. Funds are still accumulating. And I think this week's giant gap up, I mean, to a new all-time highs with this backdrop, not only does the company have great growth prospects, I think it's in a great theme. There's obviously more and more money going to go towards greener environments, and actually higher oil prices helps too, because the substitution effect, right? If energy is high, all the more benefit to have solar. It actually benefits solar as well. And so again, sometimes we're so worried about the market making a lower leg, but sometimes you have to kind of step back and say, well, if the market even just stabilizes here, who could really be that next monster winner? Because I know Bill was buying like eBay in 2002, and then the market kind of almost made a lower low in 03, but that thing was already way higher. And then by the time the market turned, eBay was up and running. And that's always kind of what happens at these market turns. So I think solar is just completely screaming that this is, a leading sector. Now, where do you buy? Obviously, the gap ups make it a little more difficult now that it's up big on the week. But
Right.
nothing is straight up. We're going to pause, consolidate, come down to an average, even if it's a shorter term average. And I'll be looking to add personally. So this is something. Some people that, you're so beaten up by a bear market, you want to quickly take a profit, but then sometimes you have to hold yourself back and say, oh no, if this is potentially a big winner, you got to think to add, not actually sell. And so it depends your mindset. But I think this is
Exactly.
just screaming leadership.
Great points there. Go
Now,
ahead,
Matt,
Justin.
the Enphase, one of the things that's was kind of tricky about this is
Mhm.
the volatility. I mean, it
Right.
was, up 7%, 8%, down 7%, 8% daily. It
Mhm.
was just, it was either up big or down big,
Yeah.
and for a lot of people, that's maybe hard to kind of get, put in your risk management properly.
Absolutely.
How do you kind of give it the room that it needs to do its normal movement? Now, I will say that, kind of as you mentioned, it was really tightening up. It seemed like if you looked at the weekly chart, the swings were getting smaller, more
Right.
recently, right before that breakout. But when you're dealing with a very volatile stock, and I mean, it's really a volatile industry, a lot of the names can be very volatile. How do you kind of put that risk into perspective?
Well, this is kind of the irony of the market, right? Like, especially, mostly IBD centric people, we're looking for these big runners. You want to make, 40, 50, 70%. But if the stocks move 10% a day, it's still difficult, even if you're trying to make a 40, because in one day you can lose 10%, but it takes time
Yep.
to make 40. But if you bring up, so Enphase, I bought on the gap up because it just clearly, in my opinion, the earnings were great. It was already a leader, and we kind of cleared all of that resistance. It was just, I said, this is the low risk opportunity where if it fails, it's over. But if it works, the resistance is gone. But that was the gap up. The reason I bought Sedge before the gap up, which maybe is a better discussion, apart from this kind of gap up area. If you look at Sedge at each of those rallies that you were talking about, I've been watching this. I was watching that same trend line, which I didn't buy on the initial trend line break. But if you look at every time it kind of rallied to that line, within 3 days, it had given back almost the entire prior advance. I mean, it was fast drops every single time. Now, the last time we got to 300, you went sideways for 3 days. You didn't budge, and it didn't do that at any other time when it went up to that line. So I said, this is the first time we're getting to resistance, and we're actually not just falling apart. So given the overall backdrop of the solar, how it was so strong and the market was strengthening, I actually bought it that day prior to the gap, and it closed a little bit lower. I said, oh, we'll see how it opens tomorrow. Unfortunately, it was a gap my way. But at least that little tightening right at the end. And sometimes I know, even if we're looking for big picture stuff, that short-term tactic to keep your risk in check is really critical, or else, like you said, it's almost untouchable, right? You have these 10, 15% moves, but sometimes you get those 2 or 3 day periods where they coil up. We say, look, at least if I'm wrong, I'll lose, 4 or 5% instead of 15%. And that makes all the difference,
Right.
in my opinion.
Well, and
Yeah, so
to a certain degree, it was like almost like a change in character, It's like, oh,
Absolutely.
I'm acting differently now.
So you said
Yeah.
you're looking for a place to add to these. What would be the ideal scenario or look? What are you looking for to add?
So that little pink line you have on the chart, is that the 10-day, I'm assuming, Ali?
Yes. We have a 10-day simple, 21-day exponential, 50
Okay.
and 200.
So usually what I found after these gap ups, and especially if you're positioned before, it obviously helps. I use usually like an 8 exponential instead of a 10. It doesn't really make a difference. It's just, I think, a matter of preference. But after these big gap ups, I've noticed if they gap up a day or two and then kind of just pause for 3, 4, 5 days, it gives it enough time for like the 10 to catch up and tag it. And that usually happens, especially in these scenarios. If you look at SolarEdge and Enphase, they both kind of just ran up to their prior all-time highs and right there kind of stopped and reversed to kind of nail everyone who's kind of late to the game one more time. Yeah, and so I think sometimes if you can see that sideways consolidation as that 10 comes up, that's where I'll be adding to the trade. It's just giving you enough time for like the short-term averages to come up.
And then how much do you add? What kind of initial position sizes did you go with these? And then how much would you be adding?
So I keep my position sizing the same. I know some people, if they have a smaller stop, they say I'll go bigger. But the problem is, like if you trade long enough, you say, oh, I got this $1 stop, but then there's bad news and the gap's down $8, and your stop is meaningless. So my risk side of my business is always fixed, and I'll usually size about a 10% of my account per purchase. Like I'm a little more aggressive. I think people who are less experienced, maybe you can make it 5% or something. But I usually buy 10% per purchase. So I'll figure out how many shares that is, and so I have my first buy, and after if I get enough of a move up and I see another entry, I'll add another 10% of my account to it, and my average cost will be somewhere in the middle, and that's how I kind of concentrate over time into the stocks.
Right. So then if you're fully invested, then you just rank your stocks and feed your winners and weed the losers, or how does that work?
So when I'm
paying,
when I'm looking at a stock, I always like my goal is to say like if it's a good stock and it's working well, I want it to be like 30% of my portfolio. So I want to find 3 ways to buy it, and I have all these kind of short-term tactics like I mentioned on SolarEdge. And I also don't like having more than like 6 or 7 stocks. So once I get to 7 stocks, which I'm probably in that position now, I have like 10%, 10%, and I'm 70% exposed. But as new buys come in and I get on margin, I just naturally start to say, well, this one hasn't gone anywhere in 2 weeks, or I'm up 2% or down, and I'll sell that and I'll add it to one that's giving me an extra buy. And that's the genius of Bill O'Neill. And I know he took some of that from Jesse Livermore. And I think that's just good practice. And that way you're always like any businessman. I know we're looking at this as trading, but any business person, you want to give more money to what's working and take away from what's not working. So I think it's just good practice. And that's how I do it as well. If you won't go down in a bear market, and you finally buy it at the right time, and it launches up and you say, wow, it wasn't going down in a bear market, you bought it right, it's up now. Any good move is going to take time. I remember reading Bill's book when I was like 15, 16. All I would look at is 700% in 68 weeks, or I never looked at the number of weeks. I just looked at the percentage return. So, for a 16-year-old, like 68 weeks is like an eternity. So I was never able to, I wanted the percentage return, but I could never stay in. And I eventually kind of learned to kind of pace myself a little bit. But if I have that relative strength, especially in a bear market, that's why I think in 2020, I had such a good year, because I saw these stocks that wouldn't go down, or they were so quick to get to new highs. And there's something that's saying so much about that stock specifically. If you take a look at Enphase ahead of time, this was again showing relative strength off this bottom and really strong off of this bottom. So typically you'll see that develop before the big breakaway move happens.
Great. And so then just a reminder for everyone how you're looking at relative strength, not just percentage, directly versus the S&P 500, but how much should it be outperforming based on the stock's beta, right?
Yeah, so that's what I do. So basically, because if you just look at it versus the S&P, only like the fastest moving stocks will ever kind of come up on the radar. And sometimes, those same fast moving stocks, well, if they are holding in, but they're still falling a lot percentage wise, they won't come up. So by kind of basically weighting the stock, not only against the S&P, but like, hey, this stock is usually twice as volatile as the S&P. So to show relative strength, you got to go up more than twice the S&P. Or if the S&P is falling and you're falling the same as the S&P, that's pretty good, because you should have fallen twice as much as the S&P. So when you start to weight the stocks move versus the S&P, but accounting for volatility, I think you get new insights that you wouldn't otherwise get.
Hey everyone, thanks so much for watching Investors Business Daily on YouTube. If you want to watch more videos, make sure you hit that subscribe button so you don't miss a thing.